Debt market update, August 2022. GSEC yields inched up at the short end on the back of increase in repo rate by RBI, while 10-year GSEC yield declined on the back of news of possible inclusion of Indian government securities in leading global bond indices. The 10-year GSEC yield ended the month at 7.19%, 13 basis points lower than last month, despite US yields hardening. The decline in commodity prices, especially energy prices, rising global growth concerns, etc., were the key drivers. Corporate bond spreads over GSEC narrowed on back of lower corporate bond supply. Average net interbank liquidity declined sharply month on month, driven primarily by US dollar sales by RBI. Further, the credit growth outpaced deposit growth during the month. FPIs bought net debt worth $0.9 billion in August 2022, as against net sales of $0.4 billion a month ago. Cumulatively, FPI flows were flat during 5M FY23, vis-a-vis net buyer of $2.2 billion during the same period last year. Outlook: the MPC minutes was largely in line with expectations, with most members expressing need for front-loading the rate hikes. Further, most members expressed concerns on inflation and need for anchoring inflation expectations. Since May 2022, MPC has raised repo rates by 140 basis points to 5.4%, above the pre-pandemic level. The commentary by RBI governor in his speech and press conferences hinted that the monetary policy is likely to remain calibrated, measured and nimble, keeping in mind the evolving economic situation. Further, he reiterated that RBI is committed to bring down inflation close to target over the medium term and will take necessary steps to control inflation and anchor inflation expectations. Thus, we believe that RBI is likely to act in a balanced manner going forward, but will remain data dependent. Going forward, elevated energy prices, resilient CPI and WPI, accelerated tightening by major global central banks, etc., are likely to put upward pressure on yields. Further, supply of state development loans, which have been muted till now, is likely to pick up in coming quarters. This can put further upward pressure on yields given the high SLR holdings of banks and robust credit demand. Further, financial conditions continue to tighten globally, with US yields rising post the Jackson Hole Symposium. On the other hand, several factors supporting lower yields have emerged and yields have corrected from the recent highs. These include rising global growth concerns, broad-based correction in international commodity prices, especially oil, etc. Risk of significant fiscal slippage by center has also reduced, given the better tax collections and recently announced measures to impose windfall tax on exports of oil and select petroleum products. Negative balance of payment in FY23 should drain the system liquidity and could open up space for conducting OMO purchases by RBI in the second half. The talk of inclusion of Indian GSEC bond inclusion in global bond indices is likely to keep a lid on yield. On an overall basis, given the counterbalancing forces at play, yields are likely to trade in a range with a slight upward bias in our view. However, it is not likely to breach the recent highs unless oil prices rise significantly. In view of the above, we recommend staggered investments into short to medium duration debt funds, with some allocation to longer duration debt funds in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.